Welcome to The Explainer. Today, we're cracking open a strategy that professional traders use to get a real edge. We're going to show you how to blend the hard numbers from a company's earnings report with the story its stock chart is already telling. Okay, so let's kick this off with a really big question. What if a stock's chart could actually give you a hint about the news before it even breaks? Sounds kind of wild, right? But the whole idea is that by learning to read the price action, you can literally see the footprints of the big money players who are already placing their bets. For the longest time, the investing world has been split into these two camps. You've got your fundamental analysts over here, buried in spreadsheets and financial reports, and then you have the technical traders who believe all the answers are right there in the chart's peaks and valleys. But the pros, they know the real secret isn't picking a side. It's realizing that each side is only seeing half the story. And this is exactly where we bring those two worlds together. We're not choosing one over the other. Instead, we're going to learn how a fundamental event, like an earnings report, acts as the catalyst, the spark that ignites a huge move the chart has been hinting at for weeks. Now, here's the key insight, the real secret. The most important clues don't just pop up after the news is out. No, they show up in the weeks leading up to it. This is the window of time when the big institutions, the so-called smart money, have to carefully and quietly build their positions. They can't just buy millions of shares at once. And in doing so, they leave a trail. And our job is to learn how to spot it. So, how in the world do you read that trail? Well, it all comes down to spotting a few key chart patterns that show up again and again in this pre-announcement window. Think of it like being a financial detective, doing a little forensic analysis on the chart. And you know what? This all tends to follow a pretty predictable timeline. About 4 weeks out, you might start to see the early signs of big players buying in. Then, around the 2-week mark, you'll see those clear chart patterns really start to take shape. The final week? That's for last-minute positioning, and you might see some weird volume spikes. So by the time earnings day actually arrives, your game plan should be set. You're just ready to execute. Okay, so the first pattern to watch for is something we call the consolidation squeeze. I want you to picture a spring being coiled tighter and tighter and tighter. The stock's price bounces between a narrowing range, and usually the trading volume starts to dry up. This is a classic sign that institutions are quietly accumulating shares. They're trying their best not to alert everyone else before the news is out. Now, a second pattern, and this one's a bit more obvious, is the pre-earnings ramp. Here, there's no hiding it. The stock is just in a steady grind higher, making higher lows. Every little dip gets bought up almost right away. This is a huge signal that confidence is building across the board as more and more people start to bet on a positive earnings report. But these signals can also be a major warning sign. In a distribution pattern, the stock might still be hitting new highs, but, and you have to catch this, the volume is fading away. That disconnect is a huge red flag. It suggests the smart money is quietly selling their shares to the excited retail buyers who are chasing the price. They're getting out before a potential disappointment. All right, the pre-earnings homework is done. Now, the news hits the wire. This is when we switch from quiet analysis to decisive action, because there is explosive momentum just waiting for anyone who's prepared. Let's be honest. The first few moments after an earnings release can be pure chaos. And that's exactly why pros use something called the 48-hour rule. It's a rule of discipline. The idea is simple. Resist that temptation to jump in on the first tick. The real, sustainable trend, that often doesn't show itself until after the first 2 days of trading, once all that initial emotional noise has died down. So when the market opens, the reaction often creates a literal gap on the chart. A great earnings report can cause the stock to open way higher. That's a gap up. A bad report? A gap down. But here's the thing. Either way, for that move to be legit, it has to be fueled by a massive, undeniable surge in trading volume. And look, volume is the ultimate lie detector. It's the confirmation. A price move on just average volume? That's questionable. Could be anything. Could just be noise. But when a stock breaks out on 2, 3, or even 10 times its normal daily volume, that's it. That's the institutional stamp of approval. It's the market telling you that the big money is making a serious, committed move. So why does this combination of charts and news work so well? It all comes down to something called the catalyst effect. See, a technical chart pattern, all on its own, is just potential energy. It's a coiled spring. The fundamental news, the earnings report, is the rocket fuel. It's the spark that ignites that potential energy and sends it flying. And this, right here, this really gets to the core of the whole strategy. I mean, think about it. How many times have you seen a perfect-looking chart breakout that just fizzles out and fails? It happens all the time. And it's often because there was no real reason for the move. A positive earnings surprise provides that fundamental justification. It gives the breakout legs. So, this all comes together into a beautiful, high-probability checklist. First, you've got the technical setup, a stock that's been consolidating and testing a clear resistance level. Check. Second, you get the fundamental catalyst. The company comes out and beats expectations. Check. And finally, you get the confirmation. The stock breaks out on that massive 2 or 3 times average volume. Check. When you get all 3 of those to line up, the odds really shift in your favor. Okay, let's make this real. Here's a case study. We have a big, well-known tech stock, and it was building that classic coiled spring pattern we talked about. It was stuck in a super tight 6-week range right before its Q3 earnings were set to be announced. The company then came out, beat earnings expectations, and even better, they raised their guidance for the future. And the result? Pow! The coiled spring unleashed. The stock absolutely exploded, running up 22% in just the next 3 weeks. And if we break down the anatomy of that trade, it followed our playbook to a T. Step 1, the setup, that tight 6-week consolidation. Step 2, the catalyst, the fantastic earnings report, beating and raising guidance. Step 3, the response, an instant 8% gap higher on 3 times the normal volume. And step 4, the result, that beautiful, sustained 22% gain. So, let's bring this all home. If you're going to take one single thing away from this explainer, what should it be? What's the complete framework you can start using? It's this idea: earnings-based technical analysis. It's not about being a fundamental guy or a technical gal. It's about using the fundamental catalyst, the earnings news, to give you the reason why a stock should move. And then using the technical chart pattern to tell you the highest probability moment of when to act. The fundamentals are the why, the technicals are the when. That synergy, that's the whole secret. So we'll leave you with this challenge. Next time earnings season starts rolling around, don't just sit there waiting for the news alerts to pop up on your phone. Go pull up the charts of the companies you follow a few weeks ahead of time and ask yourself one simple question. What story is this chart already trying to tell me?